What a week, man. NASDAQ going straight up pretty much the last 2 weeks here. And we're pulling back slightly into as we go into the Friday session. But all in all, market has been strong. Even bonds are up off their early lows from earlier this year. So things are seeming to move or seeming to continue to move in the right direction for both stocks and bonds at the moment.
Yeah,
And
the market is healing, but something that's odd is what the VIX is doing. It seems like we're kind of entering the same scenario that we had last run up back in when even was that? Was that in March?
that was in April with the whole
April.
Israel conflict.
Yep.
Yeah.
Yep. So going into that, it's like the VIX, yeah, I see that. So from the start of 2024 going all the way until April, the VIX was just not degrading, even though equities kept moving higher and volatility was down. The VIX was just staying elevated. And it seems like that's kind of what's happening this time around as well. Obviously, for not for as long, but this could be the start. What do you think about that?
I think that um, there's obviously a clear line in the sand that we don't want to accept below, and that's last year's lows, right? The 2023 lows. We have yet to really close. I don't think we have closed below that point, those lows just yet. And I think that maybe we're around what seems to be a normal corridor for volatility in this environment, that 12 to 14 range. And as long as we're in that range, I think it's outright bullish for markets and whatnot. Obviously, breaking out of that 15 range, if you want to keep it simple, right? Just go on your chart and put a line at 12 and a line at 15. Anything in there, good things happen in the market. Above that, we become especially in this regime, things become problematic. Markets start getting spooked. And then below that floor of 12, things are just maximum bullish, right? And even too bullish, I would argue at a certain point.
So, what
Um,
needs to happen for SVIX, which is one of our holdings, to continue higher? Because it really hasn't moved in about the last month now.
Well, I think with vol, right, you have to focus on the forward curve, especially with SVIX. So it's not so much where spot is going, where spot VIX is going, but it's more where the front month futures contracts are heading, right? So as you can see here on the front month VIX futures, they haven't really broken down much. And honestly, I'm thinking the reason that we aren't really under that 12 mark that I just spoke about a few minutes ago is because of the aggressiveness in the equity indices, or specifically even I mean we're looking at Qs here, but let's pull up SPY. Just the speed at which we've gone up, right? We were under mid vamp in coming into the start of this month, and once we reclaimed that, there was really no looking back. And pretty much this entire month, right, from May 31st close to where we are right now, SPY is up like almost 4% in a month, right? So like there is a pretty consistent move there in equities in somewhat of a straight line. Now, markets obviously don't go up in a straight line forever. There will be natural corrections. And I think that alone has prevented VIX from really, or volatility structure from deteriorating, right? Because when the market goes up like this, then people start looking for protection. It kind of keeps a bid in protection, even though it's not needed, right? Because it's working against you. And it's more like volatility because the market's going up so much, not because the market volatility is going up because the market's going up because the market's going up so much, not to the normal situation where volatility is going up because the market is going down and people are scared, right?
Yeah.
And I think that's what we're seeing at least right now. Maybe some consolidation in SPY, pulling back to mid vamp, possibly lower vamp, just chopping sideways. Maybe it'll put an initial vol spike on the table. As long as it's not persistent selling, I think it's going to be, maybe an idea how this would work is VIX gets up to 14, 15, fades back over, and we just chop in this range, and in that 15 to 12 corridor. And I think that alone again will be bullish for markets.
Yeah.
But what do you?
I was gonna say, when was the last time that we've been this far away from Momo on the S&P? Because
Ooh,
typically
that's a good
the
question.
market kind of mean reverts, and comes back to Momo whenever we get um, extremely deviated from it. Are we
Let me
uh,
let me
are we further than we were just a few months ago back in April?
let me just before we go to that, before we go to Momo, let me just talk about this trend line here that I drew about 2 months, about going on almost 2 months ago now, right? It was a joke on X. I was like, okay, obviously this price action did not exist at the time. We were like literally here, right? And I draw this trend line. I'm like, there's no way it's going to be this easy for us, right? There's just no way. And within like three prints, I was like, okay, like this joke is becoming reality. And then within like 4 or 5 days later, like it becomes like real that it is that easy. And lo and behold, we go to where we are right now. The markets are just up in a straight line after that break with really no reset. And this goes back to what you were just saying about the deviating back to, or I should say, reverting back to the mean, right? Momo, very interesting because we're about 8%. We have 8% downside from where we are right now to Momo. And in April of 20, of April of earlier this year, we had about, let's see, they'll let me we had about 8.7%. So we're pretty much at that same or not as deviated from Momo as we were in April, late March, early April, but we're getting to that point now where it's like there is a possibility of some sort of relaxation in price, or at least some sort of, I don't want to say reset, because again, we have to go back to the regime, right? You know this. If we're in a bullish trend and the regime is supportive, prices can reset, but we're not talking about peak pricing. We're talking about just a periodic slowdown or a periodic decline in price and then a ramp higher, just as we've seen pretty much this entire bullish trend. So I think right now we're in a position where things are starting to get somewhat stretched. I think everyone, even the bulls, understand that, right? We all like we're in a bullish stance right now in terms of the market. We're not maximum bullish, but we are still bullish. Our bullishness has reduced the last couple of the last month and a half or so, but we are still bullish. And I think that most bulls would have to agree that price action seems a bit stretched. Now we all have to also understand that just because prices are up does not mean they can't go up any further. And just because they're up a lot is not a reason why they need to go down. But this idea of a consistent, or I should say, um, a linear function return in the market where things just go up at the market doesn't rise 5% a month unless you're in hyperinflation. And don't even get me started. We are not in any period of high or abnormal running away inflation at the moment. So we don't people are going to argue that to the hill, and that's fine. But like, let's be honest here where we are. We're talking about CPI under 3.5%,
And we still
right?
have strong
So
growth. During hyperinflation, you don't really have that growth backing it up.
right. So I think all in all, markets are up, looking pretty stretched. But again, we don't short the overall market, number one, and we definitely do not short bullish trends. So that alone can give you kind of an idea on how we're looking at the market overall. But let's go to bonds, right? What do you think is going on here with bonds? Like we're seeing the bonds finally flip, long bonds finally flip to a bullish trend. So what are you feeling here?
I think bonds are sniffing something out. I don't think growth is where it was just a few months ago, and the market is picking up on that there is a growth slowdown. Whether or not that growth slowdown is enough to take down equities, that's still up in the air. But I think bonds are still starting to sniff that out, and that makes sense because bonds are not breaking out just yet. If it was evident that growth is dying to the point where inflation collapses, possibly even into deflation territory, and we are close to getting a recession, bonds would already be breaking out. But the way I see this is they're starting to price in the possibility of that, but it's just not fully confirmed yet. And we have to see how growth develops from here. But at the end of the day, employment is still high. We're in still historically high territory. There's still the job openings are still higher than pre-COVID levels. That needs to come down before unemployment rises. So growth is still very strong in terms, not, I wouldn't say strong, it's definitely weakened, but it's robust. Like it's not going to go down that easily. So I think that's what's stopping bonds from really accelerating, but they are starting to sniff something out. That's what I see.
Yeah, I think a good way to summarize what you just said is we're looking at some sort of slowdown materializing, right? Even in our models, but not so much a recession, at least not at the moment.
Yeah, and that's what's going to make it hard going forward. If this does continue, what is going to be the outperformer? Is it going to be stocks or is it going to be bonds? And I think that's going to be the big question of where should you really be allocating your money.
Well, let's actually talk about that then. So, right, like what would it take for stocks to continue to outperform bonds? And I think that the general understanding in what we just said being a slowdown and not a recession is in a slowdown what you're going to do is you're going to bring long end rates down, right? So right now the 10 years at 4.25, and in a slowdown, we're not talking about pancaking the long end, but maybe the long end coming down 50 basis points from here, maybe 75, right? So we're just back to where we were in April of 23, essentially, right? That's somewhat of what a slowdown would look like, especially given if you start to see inflation slowing materially with it, right? So it's not so much, it doesn't read more like stagflation, it just reads more like deflation, but that growth isn't really dead yet. So you're kind of fighting this expansion slash deflationary regime, right? Where you have positive growth and weak inflation, but that positive growth factor isn't extremely strong, so it's hard to decide. And I think in an environment like that, as long as growth isn't dead and you have rates coming down, you're going to bring in some sort of multiple expansion onto the table, right? Because we're talking about a Fed funds rate of 5.25 right now, with real rates in well into positive territory, and the level of restrictiveness is obviously apparent when you look at a lot of these economic indicators, right? Like you take a step back, forget real GDP. I mean, obviously, we're not going to forget it in terms of context of how important it is, but there are more indicators than just real GDP just to get an idea of what's going on. And you look across them and you see things are not as strong as everyone would like them to be. But that doesn't mean, again, you're in a recession. And I think that there's a level of a deterioration that's been picking up the last couple of months. Our models have been front running that to some degree. And I think people are starting to really notice now. And the question you need to ask is that drop in rates without a real material growth slowdown, will it allow multiples to expand to such a degree that you can pretty much keep the equity train going? Or is that growth offset going to be a very defining factor in the outcome of the equity trade? Meaning, is that growth offset that you have, maybe it's flat, maybe the market doesn't take that or accept that, and they start selling off equities. And this goes back to what you were saying earlier. I think that it's going to be easier than it's very confusing right now for a lot of people. Well, do you long bonds? Do you long equities? Do I long both? I think that as the picture clears up here in terms of the real direction and totality of the data, we're likely, if we're going to see some sort of slowdown, it's likely going to be one, at least initially, where equities can still continue to go. I think that any sort of reduction in rates without a huge retraction in growth is going to kind of give that last fuel, or we call it like the fumes in the market for multiple expansion, and what it may, whatever, however you wanted to put that down as the bottom line. And I think ultimately that's going to allow the train to go on for a bit longer. In the background, bonds are going to be working. I think at that point, I think we see TLT, up over 100, easily legging up. And at that point, I think, okay, we could, maybe we can get like the long bonds up to 110, right? That's like a 10% move in long bonds. And then depending on what happens there, how aggressive, that's 10% from 110, from where we are right now. That's, I think, what, 20% from here, roughly. So I think at that point, you're going to come into a situation where the deciding factor for the continuation of that bond trade is going to be growth actually failing. Because if growth doesn't fail in this situation, essentially what happens is you miss stage 4 of the compound landing, right? Because you get to skip it because you don't get that recession. Do I think that's a likely outcome? No. I think that we just saw last week with the FOMC and or a week and a half ago with the FOMC how straight, just outright ignorant they are to the overall data. And they can be ignorant, right? They're the Fed. They can do whatever they want. At the end of the day, they're going to be right whatever they do because they don't pay the price, unfortunately, right? So whatever they want to do, they're going to do. And I think that they should have been a bit more upfront with the fact that their forecasts were skewed. They didn't account for the more of the weaker data that's been coming in. And the one deciding forecast to push out the cuts on the curve was a misguided inflation, a misguided adjustment to inflation expectations. And I think that if they didn't do that, we could possibly be talking, and if they open the door about cutting rates at the next meeting, it would have been something that's more easy or more adjustable for the market in terms of bringing off that level of restrictiveness at somewhat of a gradual but consistent pace. And I don't think we're there yet. The Fed's not doing that yet.
Yeah,
So I think
and
we're still.
I
Go ahead.
I think that this what we're seeing now, the market's starting to price in a growth slowdown. This could actually be us finally seeing the effect of that rate hiking cycle, because it is a
Right.
delayed effect. It's something we talked about over the last 2 years as they were doing the rate hike cycle. We're saying these rates are not going to embed themselves into the economy until 6 to 12 months later. And maybe what we're seeing now with slowing growth data starting to come out, maybe this just continues. And over the next 6 months, it's just going to keep getting worse and worse. And it doesn't matter if the Fed cuts once or twice, it's just bleeding into the economy. What they did, raising from basically 0 to 5% in a matter of months, just bleeds into it. And there's nothing that they can really do about it except for a panic cut. And that could be the situation that we're going into.
And I think that brings up a very good conversation now to have with what you mentioned earlier. Like, where does the trade go? Because if where does the stock and bond trade go? Because if you don't get that panic cut, right, you don't really get that, the reason for the panic cut being a more material slowdown. As a bond investor, you don't really have that upside, right?
The upside of
You
what?
do,
Of panic
you don't
cuts?
have no, you don't have the upside of a bond of appreciation because the Fed's going to hold rates or cut them at such a slower pace than even the market's pricing in right now, or at the pace the market's pricing in right now, which means if the forward curve is pretty much in line, right, where we are right now with what we're, or should I say, if the forward curve is executed based on where expectations are at the moment, right, the upside in bonds isn't as lucrative. The upside in bonds really comes into play when you get that growth slowdown. The Fed just cutting rates slowly opens the door for some bond appreciation, but that punch in the face, rapid bond move happens when you move into a recession. So what I'm saying is, if the Fed somehow lands softly or even bumpy without really hitting the ground hard or having the economy hit the ground hard, the upside in bonds isn't going to be as lucrative as possibly equities, because you have that growth function in equities that if growth is still somewhat positive and rates are coming down, multiples are expanding, equities can continue higher.
Well, especially if inflation remains sticky at around 3%, that's also a benefit to equities and not to bonds.
Right. So we're in this interesting dynamic right now. Like, we've been saying this for, I think the compound landing is coming up in 2 months now, a month and a half away from now. It's going to be 1 year old. So the compound landing has been going on for pretty much the last year. And when we initially released it, and as we brought it up in podcasts, we always said this is not something that happens in a couple of weeks. We've been very adamant about that since day one. And we're obviously in stage 3 of the compound landing. We are 75% through it. The question here isn't if there's going to be landings. No, people say no landing, soft landings, hard landings. Look, there is no such thing as no landing. The economy is cyclical, right? So it goes up and goes down. What we're betting on here is the period of arches or the periods of peaks and troughs in that cyclical across that cyclical wave, right? You're betting when you hit the peak and when you roll over. Right now, we're at stage 3. So think of it like we're at the top of the wave, right? But are we going to stay at the top of the wave for a lot longer than everyone's expecting? And by the time we come down, people will not be really concerned about a recession anymore? Or are we going to start tipping over rather soon and start accelerating lower? And that really comes down again to the Fed. How long is the Fed going to stay restrictive? And are they going to over restrict the economy? And I think a lot of people just come to this they just come to assume that the Fed is not restrictive because nothing's breaking. But like we just saw the fastest hiking cycle in modern history from zero in terms of basis point moves from zero. Like I don't think you can just write that off so quickly. And obviously there's cracks that are starting to form. We've already seen job openings per the job opening per unemployed person, that ratio come down significantly since the Fed started cutting hiking rates. And I think that that's probably, like you said at the beginning of the podcast, the first thing to go before you start deteriorating the unemployment market or the employment market, right? Bringing up unemployment rates. Ultimately, though, I think that unemployment rates will continue to pick up here as the Fed stays restrictive. And we can bring this into the last 2 economic segments of the podcast, one being real retail sales. We got these this week. And this is adjusted for inflation, obviously, and it's negative. And if you take a look at the chart here, we came at about negative 90, almost negative 1%. You can see that ever since the Fed started out, pretty much lifted rates, this is how a hard time staying positive, right? Now, one could argue, oh, that's because inflation is so high. Not necessarily. I mean, inflation's 3%, right? Like we're talking about, or 3.2% here. We're not talking about a significant elevation in inflation from where we were in 2018, right? And for us to have consistently negative real retail sales here is just showing you that like the nominal is slowing down. I believe the nominal is actually weaker or continuing to deteriorate versus the inflationary metric that you're measuring against to get this real return here in retail sales. And I think that we're going to continue to see that happen as even if you get that inflation slowdown, you're going to need to keep this retail sales positive. You're going to still need that strong nominal number. But if that nominal number is slowly weakening, well, what's going to end up happening is you're going to just get outright negative retail sales. And this is just one of the many indicators that, again, are showing you that the picture has not been and still is not as rosy as everyone likes to make it out to be. But I mean, we're not talking about extreme crisis level stuff here. This is just, a feather in the cap for the slowdown guys or the hard landing guys. This is look like real retail sales continue to contract. And we look at GDP now, though, and we look at the final sales to domestic purchasers. This is the component within GDP now. So this is measuring the change of final sales or demand within GDP, right, for consumption. And this is at 2.87%. So we're pretty much at pre-COVID levels here. So this is not weak. And this goes back to what I think you were saying earlier, that growth isn't really, this is not recessionary, but we are obviously off the levels that we were seeing in 2021. And remember, this is real. So this is not nominal, if you want to say like, oh, this is inflation adjusted. So this is accounting for money printing, et cetera, right? So you look at where we are, even in 2022, we were at more above these levels than we are right now. We had this drop in mid 2022, which scared everybody, right? But ultimately, we continued higher and we peaked around mid 2023, and we're still up there. So we're not near zero, but it's definitely looking like it's congesting more and becoming more stable, which might be the early signs that we might see some peaking action here. So this is something to keep an eye on. It's not definitive, but something to watch.
Yeah, the question is going to be like, is this the start of something worse and it's going to just keep decelerating as the rate hiking cycle just continues to bleed in? Or are we just going to get a bounce from here and just continue higher until the actual bleed starts happening? That's going to be the question.
Right. I mean, we have real GDP at 3% still, right? It just came in today at the Atlanta Fed at 3% overall, not final demand, just actual GDP. Um, which again, that's great. That's not bad, right? 3% GDP, awesome. But what we're trying to look at here is to make sure that the underlying stays strong. And we can't just look at something like this and say, oh, when it gets to zero, we'll know we have problems. The market's going to foresee this coming. By the time we get to zero on this, the market will have sensed that already, right?
Yeah, bonds are
Just
going to
like
be
by
at
the
120 already. But
yeah, but by the like for example, in 2022 when we hit zero, like we hit zero on this maybe mid 20 looks like mid 2022, right? The market was already in the gutter. So you have to assume the market's going to somewhat front run this, and that's why you have to look at much higher frequency data than this. This is just a good indicator that the economy is still strong, um, yet at the same time we are at a point where things could start to weaken and eventually hit real GDP figures here. And I guess if you're looking at this, the thing you have to watch for now is, did we put in a peak for 24 on real final sales and overall real GDP? We'll have to see. That is to await. But let's wrap this podcast up with Bitcoin. This has been on everyone's mind lately. It's been going down since June 6th, pretty much all month. Outside of the first week or half a week, this thing's been pretty much straight down with a couple of updates. So everyone is wondering, is the Bitcoin ride over? What do you think?
I think Bitcoin is just as confused as bonds are right now. So I'm curious, what does it look like if you put TLT on this?
Well, let's take a look.
Somewhat of an inverse move lately as bonds are starting
Somewhat.
to pick up a bit of a growth slowdown. I think Bitcoin is also wondering where is growth going to go, because Bitcoin is a very growth dependent asset, and it's honestly probably like the most growth dependent. During times of low growth, Bitcoin just goes in the gutter. Every time we had a massive Bitcoin sell off was when growth expectations were low. And I think that's just what's happening right now. We're kind of in that point where some data of slowdown is coming out, but we just got Atlanta Fed GDP print of 3%, so we're kind of like in that in between area, and it's just waiting to have some more confirmation on higher growth expectations. And I think as soon as higher growth expectations come out, Bitcoin is going to be at new all-time highs. It's going to happen very quickly.
Right. So, like for example, take a look at this. Right. So this is retail sales, and this is where we're going to finish this podcast up on. If you take a look here, and this is what I was speaking about earlier. Like we'll just draw a zero line in here. So you see how we've pretty much been trending down, and we somewhat stabilized in 23, and we started like lifting up. We went from about a nominal of 1.6 all the way up to 5.5 at the end of December, and things started to seem like, okay, we might be starting to get some like normalization. And then early this year, we had this dump and bounce back up, but like now we're dumping back down again. So the question now is, does this slowdown material or continue to the point where we get this closer to zero? Remember, the market isn't going to just start acting when this is at zero, right? When economic indicators get to zero, the market's not like, oh my God, time to start moving. They price things in proactively. So again, real retail sales negative, meaning adjusting the nominals for inflation, you're essentially not growing, you're declining because of inflation. And we have what you just said earlier about bonds slowly stiffening up here on the idea that growth could be slowing, and Bitcoin coming off a little bit. And this goes back to what I said, where if we are in this situation where the Fed actually can reduce interest rates without letting growth die, what's going to happen is you're going to get that multiple expansion, boosting equities to some degree, not all equities, obviously, not all equally. It'll help bolster equities, I should say. And you're going to get some bond trade, some sort of bond move, depending if it's going to be a long-term trade or not. It's going to depend on where growth ultimately goes. But thank you guys so much for listening. We'll talk to you guys again next week. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.